Hello all. In today's lecture, we are going to learn about the valuation of equity shares. In the previous lectures, we have already learned about how we are going to value the bonds, debentures and preference shares. So let's start with the equity shares. So first of all, let's see the features of equity shares. First feature of equity share is share right. That means what rights does the equity shareholder enjoys. Now, if we talk about the equity shares does not have a coupon rate as there was a coupon rate in case of debenture, bonds and preference shares. And in equity shares, dividends are paid from the profit. That means if the company is having profit, then only the dividend will be paid to the equity shareholders, and that too when it is passed by the board of directors. That means board of directors decide whether the equity shareholders will get the dividend or not. So it's not a guarantee that when the company is earning profit that the equity shareholders will get the part of profit as a dividend. Next right is that equity shareholders can trade their shares in the secondary market. That means the equity shares have the liquidation rights, and when the equity shareholders are selling their shares in the secondary market, they can get the capital gain. Equity shareholders also have a right to vote and to elect the directors who will be responsible to take the decisions with respect to your mergers, your sale of assets, dissolution or maybe any other decision which is being decided by the director. Now, if the company goes into the liquidation, equity shareholders also have a right to receive the proportionate distribution of the asset. But over here you have to keep in mind that equity shareholders always stand in the last of a queue. Now over here the queue means that once the company has paid all the debts which has to be paid to the creditors, bondholders, short-term lenders, bank, trade creditors or any other outstanding liability. So once the company has paid all these things, and then only if it is left, some part of the profit is left, then only it is paid to the equity shareholders as dividend. Or if the company goes into the liquidation, the first right to receive the proportion of the asset is for creditors, your debtors, your bank, your lenders, and after that also if it is something is left, then the equity shareholders are going to receive it. And if after paying all the debt, nothing is left with the company, then the company is declared to be bankrupt and the equity shareholders will not get anything. Next feature of equity share is uncertain returns. As we all know that dividends are based on profit. That means if the company is earning profit, equity shareholders will get the dividend. And profit is uncertain. There can be the profit or even the loss can be there in business. So we can say that returns are uncertain, and even the company is earning the profit, it is not a guarantee that the equity shareholders will get the dividend. If the company is having a very good business opportunity, company can retain all the profits in the business, which means that the equity shareholders are not going to get any dividend. Next feature is the valuation based on dividends. Now in this it says that if you are going to value the shares, or you can say the present value of the shares which is prevailing in the market, it is based on dividends. As we already know that some companies pay dividend and some companies do not pay dividend. If the company is earning more, then also company does not want to pay dividend if it is as a very good business opportunity in their hands. It can also happen that the company is earning more but the company is paying less dividend to the shareholders. But the shareholders can get the capital gain at the time of sale of these shares in the secondary market, or even the equity shareholders get the returns at the time of corporation transactions such as mergers and acquisition. So we can say that the valuation of stock is based on earnings, your capital gains and mergers. Next is valuation based on earnings. Now over here the valuation based on earnings means that the value of the share is based on earning per share and price earning ratio. Now in today's lecture we will be discussing about the valuation based on dividend. Now in this number line we can also see that it's given to be infinity. The one of the feature of equity share is that the company will never return your money back. If you want the money, you have to go to the secondary market and sell your shares. and company is going to pay dividend after every regular interval of the time. And dividend is paid till the life of the company. That means you are not aware that when the last dividend will be received. Now let's discuss the valuation based on dividend. So the following features of the valuation based on dividend are that the company pays the dividend annually. That means there is a regular interval between the two period dividend. The equity shares are sold at the end of the year, and the first dividend is paid by the company after 1 year from the date of purchase or acquisition of shares by the shareholder. So these are the certain features on which the valuation is based. Now if we talk about the valuation based on dividend, it is being divided into two parts. That means the dividend can be constant dividend or there can be a growth in dividend. If we talk about growth in dividend, the growth can be constant and growth can be variable. So first of all, let's discuss about the constant dividend. Now constant dividend means that the company is going to pay exact same dividend every year. That means whatever dividend the company is paying at the end of year 1, the same dividend the company is going to pay at the end of year 2, and the same dividend at the end of 3, at the end of year 4, at the end of year 5, and so on. That means till the life of the company, each and every year equity shareholders are going to get the fixed amount of dividend. Now in this you can see that if the company is paying dividend and your end is not known, so this is forming a perpetuity. Now if we have to calculate the present value of the shares in case of constant dividend, we have to convert all the dividend received into the present value. We have already discussed about the equation. So the equation becomes d1 upon 1 plus ke plus d2 upon 1 plus ke raised to power 2 till r infinity. Over here d1 is equals to d2 will be equals to d3 will be equals to d infinity. So this is forming a part of perpetuity. So we can directly use the formula which is being used in a perpetuity. So the formula for perpetuity says cash flow divided by R. So in this case the cash flow is dividend, so we can write D, and R is K. So we can say that present value of shares in case of constant dividend will be dividend paid divided by cost of equity. Let's take an example. ABC Limited declares the dividend of rupees 10 on the share with a face value of rupees 100. The amount of dividend is expected to remain same throughout. That means it is a constant dividend and the shareholders are going to receive rupees 10 as a dividend every year. The expected rate of return on investment is 18%. That means cost of equity is given to be 18%. You have to calculate the present value of equity share. So we can say that at the end of every year, the shareholder is going to get rupees 10 and the shareholder is going to get rupees 10 till infinity. So the formula says present value of share will be D upon KE. D is 10 and KE is 0.18. So let's put the values in the formula. So our answer will be rupees 55.55. So we can say that value of equity share is rupees 55.55. Now there is a question for you. It says ABC Limited declares the dividend of rupees 25 on the share with a face value of rupees 200. The amount of dividend is expected to remain same throughout. The expected rate of return of the investor is 12%. Calculate the value of equity shares. Hope you have understood the concept. For further reference, you can refer my book Financial Management. Thank you.